So if you want to secure a property in San Diego today, having a pristine credit score and a really steady, high-paying W-2 job might actually be the exact things holding you back.
Yeah, it sounds completely backward, doesn't it?
Right. I mean, today we're looking at why the most successful buyers in the city just, well, they don't care about traditional banks at all.
Not even a little bit.
Picture this, okay? You're standing on the pavement in San Diego. It's June 2026. The air is just humming with competition, and the median home price has just hit the $1 million mark.
Which is wild to think about.
It is. And that's no longer the ceiling here. That's just the baseline to even step onto the field.
Right, and it creates a staggering barrier to entry for, the average consumer. But for a specific tier of real estate investor, that $1 million mark is simply the cost of doing business.
Exactly.
The traditional rules of buying a house, the slow, steady steps we're all taught from a young age, they just simply do not apply to the world of rapid-fire real estate investing.
They really don't.
If you try to play by conventional rules in a market this cutthroat, the deal is gone before you even submit your paperwork.
Gone. And that is the core mission of today's deep dive. We're going to decode the highly specialized, kind of hidden financial weapons that high net worth investors use to consistently beat out traditional home buyers.
It's a completely different playbook.
It really is. And we're pulling from a fascinating stack of sources today. We've got a collection of local market guides alongside a series of recent June 2026 blog posts from a firm called San Diego Hard Money Lender.
Great local insights in those.
Oh, for sure. They were penned by a local industry insider named John Constantine. And we're really treating this material as a playbook. We want to show you how to start thinking like a shark rather than just a consumer.
I like that. Thinking like a shark.
Mm-hmm.
But to do that, we first have to understand the massive bottleneck that forces these investors to seek alternative weapons in the first place.
Okay, let's unpack this because the traditional banking system is just built for the slow lane, right?
Completely. I mean, if you find a property today, a big box commercial bank is going to take 45 to 60 days just to close the loan.
Wow.
And that time frame is grueling.
You're handing over your entire life history. The banks demand endless paperwork, years of tax returns, personal income verifications. It's like 3 full months of soul-searching due diligence.
Exactly. But the real bottleneck isn't just the paperwork, is it?
No, it's the physical condition of the property itself.
Right. What's fascinating here is that commercial banks are essentially assembly lines for very standardized loans. They originate these mortgages with the intention of selling them on the secondary market.
To government-sponsored entities, right?
Yeah.
Like Fannie Mae and Freddie Mac.
Spot on. And those massive secondary buyers have incredibly strict habitability guidelines. Because of that downstream pressure, traditional banks demand properties that look, well, Pinterest board ready.
So the house needs to be in a condition where someone can immediately drop their bags and sleep there tonight. Let's apply that to a real-world scenario. Say you're an investor and you spot a coastal fixer-upper in Encinitas. The location is incredible, but the house has a terrible pest report, there are exposed wires, and the kitchen has literally been gutted to the studs.
Oh, totally stripped.
Right, no cabinets, no sink, nothing. You take that property to a conventional bank, what happens?
They will deny the loan outright. I mean, they will show you the door before the ink on your application is even dry.
Because they just see risk.
Right. The bank's risk modeling looks at that distressed property in Encinitas and sees an uninhabitable liability. They see an unacceptable level of risk because their entire model relies on the collateral being functional on day one.
Functional on day one, yeah.
But a professional investor looks at that exact same gutted kitchen and sees blank canvas. They see a massive profit margin hiding behind, a few weeks of drywall and plumbing work.
Relying on a traditional bank in this kind of San Diego market is basically like showing up to a high-speed chase on a bicycle.
That's a great way to put it.
By the time your conventional 30-year mortgage is finally approved, someone else has already swooped in, bought the house with cash, and is probably halfway through painting the living room.
They're already picking out curtains.
Right. You need velocity. Which brings us to the actual financial engine these sharks are using to bypass the banks entirely, which is hard money.
Yes. The infamous hard money.
Okay, I have to stop here, though, and play the role of the skeptical listener.
Yeah.
You keep calling it hard money. And I gotta be honest, to an outsider, that sounds predatory.
Oh, totally.
It sounds like something involving a guy named Vinny operating out of a poorly lit pool hall. Why are we treating a loan with such a scary name as a legitimate tool?
The industry suffers from a terrible branding issue for sure, and your reaction is completely natural. Historically, hard money was whispered about as a loan of last resort.
Right, for people who are in trouble.
Exactly, for borrowers who had terrible credit and just couldn't get approved anywhere else. But the modern reality of this financial product is completely different. We really need to reframe what this is.
Okay, so what is it today?
Today, hard money is a highly strategic agility tool. It's a specialized short-term bridge loan used by seasoned professionals specifically to acquire assets at high speed.
Speed really is the defining characteristic here. The sources highlight that a private lender can fend a deal in 5 to 10 business days.
Which is light speed compared to a bank.
Right, and in some ultra-competitive scenarios, they can provide funding in 48 hours, issuing a preliminary approval letter in just 24 hours. Wait, how is that physically possible when a massive bank needs 2 months?
Well, private capital operates outside the massive federal regulatory frameworks that handcuff commercial banks. But the fundamental mechanism that allows for this speed is the nature of the underwriting itself.
Oh, meaning what they're actually looking at to approve the loan.
Right. These are asset-based loans. A traditional bank underwrites the borrower. A private lender underwrites the real estate.
That is a huge distinction. So the lender doesn't actually care about a minor blemish on your FICO score from 5 years ago.
Not really, no.
And they aren't scrutinizing your W-2s. They just care about the intrinsic value of the dirt and the structure sitting on it.
Exactly. And they care that you have skin in the game. That usually means bringing a 20 to 30% down payment or having equivalent equity.
So the lender knows you have something to lose if you just, walk away.
Right. Because the loan is secured by that heavy equity position in the asset itself, they can just skip the 45 days of personal background checks.
Wow. And when you have access to that kind of institutional speed, it completely changes how you negotiate. You can walk up to a seller and make a non-contingent offer.
That is the ultimate power move.
You aren't asking the seller to take their home off the market for 60 days while you cross your fingers and hope your financing doesn't fall through. You're offering them a sure thing, backed by private capital, closing next week.
It literally turns your bid into a hammer. Imagine there's an emotional home buyer offering full asking price, but they're tied to a 30-year fixed-rate timeline with a dozen different inspection contingencies. Then you come in with a hard money offer. Even if your offer is slightly lower, you can close in 5 days with 0 contingencies. The seller is going to take the fast, sure money almost every time.
Almost every time. Okay, so the hard money bridge loan got us the keys. We used velocity to beat the traditional buyers, but now we own a gutted house in Chula Vista with no kitchen.
Right.
We spent all our liquidity on the down payment. Where does the cash actually come from to buy the lumber, pay the plumbers, and make the house livable?
This is where we introduce a specific variation of this financing called a fix and flip loan.
Okay.
A standard bridge loan just helps you buy the property. But a fix and flip loan covers the acquisition and the construction.
Oh, wow.
The private lender will provide a high loan-to-value, or LTV, ratio. They might fund up to 80% of the purchase price of the home. But the crucial piece of the puzzle is that they will also cover 100% of your renovation costs.
Wait, really? 100%? Here's where it gets really interesting. Why on earth would a lender hand over hundreds of thousands of dollars for renovations on a house that currently isn't even worth that much?
Because the lender isn't valuing the house based on its current gutted state. They base the loan on the after repair value, or ARV.
The ARV.
Yes. This is the most important metric in the room for a real estate investor. The lender sends an appraiser to look at your architectural plans and your budget.
Okay.
They calculate what the house will be worth in 6 months once it has the brand new quartz countertops, the open concept layout, and the modern landscaping. They are literally lending you money against the future value of the property.
The leverage involved there is staggering. I mean, if you're an investor with $200,000 in liquid cash, you could drain your entire savings account to buy materials and painstakingly fund one single flip yourself.
Which is what a lot of amateurs do.
Right. Or you use the lender's money to cover 100% of the construction. Now, you can use your personal cash to put down payments on 3 different properties and run 3 flips at the exact same time. It's like an adrenaline shot for your portfolio.
It absolutely is.
But surely the lender isn't just handing you a duffel bag full of cash on closing day and hoping you actually build a kitchen.
Oh, far from it. Handing over the cash up front would be an astronomical risk. Instead, the renovation funds are held securely in an escrow account.
Makes sense.
The money is released to the investor in tranches, which the industry calls draws. The investor and the lender agree on a construction schedule beforehand.
So like phase one is pouring the new foundation and framing the walls.
Exactly. The investor completes that phase, an independent inspector goes to the property to verify the work was done to code, and only then does the lender release the draw to reimburse those costs.
That acts as a brilliant safety mechanism. It protects the lender's capital from walking away, but it also forces a rigorous, uncompromising discipline onto the investor's project timeline.
It keeps everyone honest.
Right. Okay, so we have the fast money to buy the house, and we have 100% of the renovation costs covered based on the future value of the home. I'm looking for the catch here. And looking at the data from San Diego Hard Money Lender, the catch is glaringly obvious, isn't it? It's the cost.
Yeah, there's always a catch. Private money is incredibly expensive compared to standard consumer debt. The interest rates are designed to reflect the speed, the convenience, and the asset-based risk the lender is taking on.
The sources show that hard money rates in California hover between 9 and 12%. I mean, the data from late 2024 specifically had this San Diego average sitting around 9.93%.
Right.
To anyone sitting at home paying maybe 5 or 6% on their primary residence mortgage, looking at a 12% interest rate sounds like financial ruin. It sounds like you're swimming in quicksand.
It does sound terrifying, but context is everything here. If we connect this to the bigger picture, you have to separate the mindset of a homeowner from the mindset of a business operator.
Okay, how so?
Well, a homeowner holds a mortgage for 30 years, right? Where a high interest rate compounds into hundreds of thousands of dollars of lost wealth. But an investor is holding a hard money loan for 6 to 12 months. It's a short sprint.
Okay. So when you run the actual math on a 6-month timeline, the shock of that double-digit interest rate completely fades away.
Exactly.
You plug that 12% into your pro forma, which is just the financial projection spreadsheet investors use to map out every single cost and expected profit on a project. When you see it on the pro forma, it stops looking like a penalty.
It just becomes another line item.
Right. It's a material cost, no different than paying for lumber or roofing shingles or city permits. If paying an extra $10,000 in interest over 6 months is the absolute only way to secure a property that will ultimately yield a $100,000 profit margin, well, the math makes the decision for you.
It's just the cost of access. However, accepting that high cost reinforces the absolute necessity of having a rock-solid exit strategy.
Right, getting off the bridge.
Exactly. We called this a bridge loan earlier. The cardinal rule of real estate investing is that you never, ever step onto a bridge without knowing exactly where you're going to step off.
For sure.
The interest rate isn't the primary risk. The true risk is failing to execute your exit strategy and getting stuck on the bridge when the loan term expires.
Because if the project stalls or you can't sell the house, that 12% interest will eventually eat through your entire profit margin.
It'll bleed you dry.
So what is waiting on the other side of the bridge? How do investors actually exit these high-cost loans?
There are generally two paths. The first is the traditional flip. You finish the renovations, put the beautiful, modernized house on the retail market, and sell it to a traditional family for a lump sum profit.
You pay off the private lender's principal, and you pocket the margin.
Right. But the second option is where we transition from chasing one-off paydays to building long-term generational wealth. It involves a strategy known in the industry as the BRRR method.
Okay, the BRRR method.
Buy, rehab, rent, refinance, repeat.
Let's walk through that mechanism because this is huge. We use the hard money to buy the distressed property. We use the escrow draws to rehab it. Now, instead of selling it, we put a tenant in the property to rent it out and start generating monthly cash flow.
Yes. And that monthly rent stabilizes the asset. Now that the property is newly renovated, fully habitable, and generating verifiable income, it looks incredibly attractive to a traditional long-term lender.
Oh, so you execute the fourth step, you refinance.
Exactly. You take out a new traditional 30-year mortgage at a much lower interest rate based on the new higher appraised value of the home. You use that new loan to completely pay off the expensive 12% hard money loan. You've successfully crossed the bridge.
And because you force so much appreciation during the rehab phase, that refinance often allows you to pull your original down payment right back out of the property.
Which is the holy grail.
Right. Which leaves you ready for the final step.
Right.
Repeat. You take your original cash and go hunt for the next distressed property.
It's an engine.
It really is.
Yeah.
In a market like San Diego, where the demand for housing continually outpaces the supply, stabilizing these properties for the rental market is incredibly lucrative. And the sources point out a massive trend investors are using during that rehab phase to squeeze even more value out of the dirt, which is ADUs or accessory dwelling units.
Oh, ADUs are huge right now. San Diego has aggressively loosened zoning laws regarding ADUs to combat the housing shortage. Investors are taking standard single-family lots and building backyard granny flats or converting detached garages.
Instantly turning a single stream of rental income into two.
Exactly. It drastically increases the property's yield and its final appraised value when they go to refinance.
And investors take these same fast money principles and scale them up. You don't have to stop at single-family homes with backyard units. You can use bridge debt to acquire multifamily properties, duplexes, fourplexes, or even mid-sized apartment buildings.
The jump to multifamily is a strategic masterstroke for a growing portfolio because it introduces massive economies of scale.
So what does that actually mean in practice for the investor?
It means efficiency. If you buy a fourplex, you have 4 income streams under one roof. When the roof needs replacing, you're only paying for one roof, not 4 separate ones across the city.
Oh, right.
You're only paying one landscaping crew to mow the lawn. Your property management becomes centralized. And more importantly, your vacancy risk disperses.
That makes total sense. Because if you own a single-family rental and your one tenant moves out, your vacancy rate spikes to 100%. You are entirely on the hook for the mortgage that month out of your own pocket.
Yeah, which hurts.
But if you own a 10-unit apartment building and one tenant leaves, you still have 9 other rent checks coming in to easily cover the debt.
Exactly.
But here's the roadblock I'm seeing. To keep these properties long-term, you have to refinance out of the hard money and into long-term debt, like we said. And we established earlier that traditional banks hate the unconventional. Real estate investors are famous for utilizing heavy tax deductions, depreciation, and write-offs. On paper, a brilliant investor often looks broke to the IRS.
That is the exact paradox of real estate wealth. This
Yeah.
raises an important question, right? Standard bank underwriting actively discriminates against self-employed individuals who utilize perfectly legal, aggressive tax strategies.
Because they just look at the bottom line.
Right. A conventional bank looks at an investor's personal tax returns, sees a heavily minimized personal income due to depreciation, and rejects the application, claiming the borrower doesn't make enough money to support a $1 million mortgage.
Wow.
The conventional system is just stubbornly designed for people with simple salary W-2 jobs.
So if the traditional bank won't refinance the apartment building because the investor's tax returns look too light, how do they secure the long-term debt?
They utilize the ultimate takeout weapon, the DSCR loan. That stands for debt service coverage ratio.
Okay, break that down for us. How does a DSCR loan bypass the whole tax return problem?
Well, a DSCR lender completely ignores the investor's personal income. Completely. They don't ask for personal tax returns. They don't care about a W-2 history. They underwrite the loan strictly by comparing the property's verifiable rental cash flow against its monthly debt obligations.
So it's all about the property.
Just the property. If the building generates $10,000 a month in rent and the mortgage payment will be $7,000, the property clearly supports its own debt. The loan is approved based on the math of the asset, entirely separate from the borrower's personal tax footprint.
Okay, let me make sure I'm wrapping my head around this. So what does this all mean? It's basically like the house itself is putting on a suit, walking into the bank, and applying for the loan based on its own resume. Your personal finances are left totally out of the equation.
That is the perfect way to visualize it. The DSCR loan is a crucial tool because it levels the playing field for entrepreneurs. It shifts the focus away from the manufactured reality of a tax return and places it squarely on the verifiable income-producing reality of the physical asset.
It really is a completely different paradigm. So let's bring this all back home. If you want to survive, let alone thrive, in an ultra-competitive environment like Southern California, you have to recognize that these specialized tools, private bridge loans, fix and flip funding, DSCR takeouts, they aren't just conveniences for the wealthy. They are necessary weapons for anyone trying to acquire assets.
They really are. The traditional banking system is simply too slow, too rigid, and too disconnected from the realities of distressed asset recovery to be of any use in a fast-paced transaction.
Success here demands a fundamental shift in mindset. You have to stop looking at real estate through the lens of a traditional consumer who's paralyzed by a 12% short-term interest rate or terrified of a property that needs a new kitchen.
You have to think bigger.
You have to start prioritizing speed. You have to focus on the future after repair value, and you have to understand the immense power of leverage. It's about utilizing outside private money to secure the asset in 48 hours, forcing the appreciation through rehab, and then smartly transitioning into long-term debt backed entirely by the property's own cash flow.
Beautifully summarized. And as we wrap up this exploration, I want to leave you with a broader concept to mull over.
Okay, let's hear it.
We have just spent our time dissecting how private, asset-based lending models are thriving because they bypass the red tape. They entirely ignore a person's historic credit score and personal income, focusing solely on the pure math and potential of the asset itself.
Right.
If this model is proving so incredibly successful and resilient in the multi-trillion-dollar real estate sector, could this philosophy eventually bleed into other industries?
Oh, wow.
Could we be looking at a not-so-distant future where the traditional, highly restrictive, personal, credit-obsessed banking system is bypassed entirely in favor of a new economy that simply funds pure asset potential?
Now, that is something to think about the next time you hear someone complain about the speed of a standard bank approval. Thank you for joining us as we explored the hidden financial engines powering the real estate market, and we look forward to having you with us for our next deep dive. Take care.